US markets, given that really the whole process of bringing private markets to wealth management clients for a place like Citigroup means you have to be adept at meeting the needs of investors as disparate as LATAM, Middle East, Europe, UK, Asia. It's just like there's no one size fits all, and to do it at a cost point that means that you don't need the scale of a Citigroup to be profitable if you're an individual wealth manager. So that's really it. The structures in the JP Morgan Private Bank and Citi Private Bank were pretty innovative 12 years ago in the way that they're designing construction. Very flexible to deal with lots of different vehicle types, but very expensive, clunky, and needed big scale. So we needed to do something for Saranac Partners, which is a UK wealth manager, where it worked at 10 or 15 million, not 400 million. So, and we perfected that. And when we started PM Alpha, because we really wanted to bring that to the wider wealth management universe globally, because I run Neuberger's LATAM business and set up a UCITS business for third-party distributors to distribute in LATAM. Beacon was the name of the company. We were approached by them who, because they'd been trying to sell a BDC in LATAM, difficult, and they persuaded Bearings was the company to utilize iCapital with its Cayman feeder structures. That made life easier for Bearings, but didn't make life easier for distributors. So we basically took a look at it from the ground up. Citigroup had distributed all of its private markets, private equity, closed-ended structures through ETNs in LATAM, big part of their raises. I had done that. There seemed in these semi-liquid private markets vehicles to be a kind of a crossover structure that brought the best of funds world and the best of securities pathways to the market. And that's what we built. So it's tried and tested. We have about 1.5 billion in AUM, of which 500, 600 million nearly is drawn already. Of course, in semi-liquid world, it's just a regular subscription model. And I think the ETNs are not new. You're quite right about that. But I think we do build them pretty differently because we come at it from a UCITS mindset and a private markets fund mindset. So they're built with all the third-party infrastructure providers that you see in a fund. So they're trustees, custodians, independent auditors, price and calculation agents. All of those things are built into the infrastructure, which takes away the balance sheet and spread impact of a bank-issued ETN. And also, I think, gives people the kind of institutional level comfort that you're not investing in something which has pollution risk from other assets, which was a big problem for flex funds when they were a few years ago, where one investment polluted other vehicles, which I think put people off the market for a long time. So we build them like a fund. They operate like a security with all the benefits that brings from a distributor base. I think the other unique selling point there, if you will, is that an ETN is just an ETN. And the complication goes into all the market infrastructure we built around it. It's a digital platform. It has all the reporting in it, which in rebate land is very important. So people know when and how much they're being paid. And even price availability in Bloomberg, Refinitiv, SIX, all these different places was not easy to achieve, and was a bit of a bumpy road to get it all tried and tested and shipshape, as we say. So that really, I think, was the journey that we took, and I call it market infrastructure. You've got to have that whole soup to nuts support of the distributor. We do all of the sub-distribution agreements. We do all of the KYD and the ongoing monitoring that goes in hand with that. So really, it should be easy for the wealth managers to use. That's priority number one. Very light touch from the asset manager point of view, because we're an intermediate infrastructure that takes the burden of the regulatory and distribution pattern, and hopefully really easy and constructive and supportive to use for the appointed salespeople. We don't sell; we work with sales teams appointed by the fund manager. So we want to make their lives easy as well, because the bigger the AUM success, the better it is for us. We don't make money out of launching vehicles. We really don't. What we do is we're aligned in aggregating AUM. That's really where our margin.
May I jump in and ask some operational questions?
Please go ahead.
I guess on the way in, you, with these notes, I assume, cannot deal with the capital call structure, right? The note is DVP, and once it's purchased, the money shows up, and then we have to deal with it. Is that a fair assessment?
No, the way we built them deals with capital call. We do all the capital management, and we handle that subscription process. So the capital calls basically are treated like subscriptions each time we administer them. So we have capital call structures in our ETNs. All of the Citi Group ETNs were just that. They were closed-ended capital call products. So actually, the new thing for us is semi-liquid. To be honest, the old stuff is the capital call stuff.
Got it. Okay. So when basically a financial advisor subscribes to the ETN, they would not immediately have to send in the money.
That's right. So there's an operational pathway here which is slightly novel, which I think we have 120 wealth managers in LATAM that are using this system. So I think it's become an easy thing. But with an ETN and the security, it's a subdoc. So we actually require the wealth manager, the advisor, or the centralized trading team to fill in a pre-trade order form. And that allows us to collect the right information, what the rebate levels are, the different share class, etc. They can have it signed by the client, or they can sign it on behalf of the client. It's molded to fit the individual distributor. And that we collect those tickets throughout the month, and the closing deadline of the trades, we aggregate them and provide a trade instruction for the dealing desk of the wealth manager. They put it into Net360 or whatever else they're doing in Pershing or Julius Baer or JP Morgan. We have 65 custodians, believe it or not. And the second purpose of the pre-trade order form is that only trades where we have a pre-trade order form settle in the market. And that means that there's no secondary liquidity unless desired. But if it's a fund, then it's best not.
That makes sense.
And that's basically how we operate. And because of the pre-trade order form, we have 100% record. See it coming.
Got it. If your vehicle then shows up at our Cayman vehicle, let's say, I assume that the KYC is on the vehicle itself, right? Or you have, how does the KYC AML work for like a Cayman investee vehicle?
So we're onboarding the fund manager and its vehicle. But we're B2B, so every single distributor, wealth manager, family office, whoever, signs a sub-distribution agreement, because we are a global distributor of our own vehicles, and that legalizes, if you will, or contractually obliges them to certain reps and warranties, such as they're applying appropriateness, they're doing the KYC. Not only that, but because it's a security, it's going through the usual securities pathway of the custodian banks for each of the clients, and they are also doing their own KYC. And we have that contractual relationship as well.
Okay.
So
Mm-hmm.
and that's actually one of the principal benefits of a security like this, is that you're doubling up on KYC, but you're not asking anybody to do additional KYC that they haven't already done.
Bill, that's what we have to check with SS&C, which is our fund administrator and the AML service provider, that they get what they need. But I assume that has been figured out. Okay. And then our underlying fund is open-ended. It has a 2-year lockup and thereafter quarterly liquidity. How can this structure deal with redemptions?
It's exactly the same as you. We
Okay.
just add a couple of days onto the deadlines because there's an intermediate vehicle. We need the extra time, but this is a pass-through vehicle, and generally speaking, no, I'd say our default position is that we replicate precisely the terms in and out of the underlying vehicle. Sometimes they vary it. So when we did bearings, they actually put a 12-month lock on that vehicle, which the underlying doesn't have. But it's flexible and bespoke, right? So we build it to your requirements.
So with our fund, like, you sign up today, Bill signs up in a year, I sign up in 2 years, then our lockup would end in 2, 3, and 4 years respectively. And we know this because we have a subscription with Tom, Bill, and Andreas. Now, the notes issued look relatively homogeneous. How do we know that this one note holder that wants to redeem is after the 2-year lockup? Or do we have to have different series, and everything that is issued in, let's say, Q4 of this year then has a certain lockup, and everything that's issued in Q1 of next year? Is that the way to handle it, or?
No, we keep the records. So the lockup period follows each investment.
Okay.
So we do that record keeping, bookkeeping, if you like, and we're an infrastructure as a service. So we provide full transparency in that. You can see as much as you like.
Okay, that's a lot of complexity that you're handling then. If, like, each note you track its issue date and redemption date. Okay, but that's very good. Okay.
It's possible by system design. I mean, it's about utilizing all the character spaces in the different custody systems. You have 35. Technically, you have 35 available. You can do quite a lot with 35 numbers. So that is how we do it. Yes, it is in the old days, it would have been a cumbersome process. We're pretty well architected from a tech point of view, so it's doable. But it's a requirement at the end of the day. And we do have it, actually. We have people redeeming from time to time who have been in the fund less than 12 months, and it's rejected.
Got it. Okay. And then I guess, what do we and you need to do to get us, for example, onboarded and ready to issue notes? I assume from your presentations you have all the service providers. It's conceptually creating a new compartment. So it would be a matter of creating the offering documents for that.
That's right. Primarily. So our little process is that we have it may seem a little overly prescribed to you, but it's how we keep our legal costs down, if I'm transparent. We have a commercial term sheet that lines out the cost, the timelines, and the services provided. It's non-binding, but we like people to agree it, at least, so that we know what we're building. Upon receipt of that, we'll do a deal term sheet. That's a technical document that outlines all the different terms. We ask for that to be signed. And then once we're contracted, which is a simple manufacturing contract normally, big companies like Ares use this on a solution basis, so it's like multi-layers. But once that's done, then we'll simply move to issuing the series memos for each of the notes concerned. You're right, we have a DAC that's sole purpose is issuing Section 110 SPVs that are listed. They're ready to go. It takes us not long, actually, 2 weeks to make the notes available. The ISINs normally come late in the process. But it's for us, it's a relatively straightforward. We have 10 different managers using the notes now. It's well oiled now from an issue point of view. All in all, from the date of contractual engagement, so we've all agreed the contract and it's signed. Let's say that's done by the 15th of September. Our platform would be collecting trade orders in the month of, what did I say? 15th of September, the month of October, for the first trade date to be the month end of that month. So from start to finish, really, in execution mode, 6 weeks is the maximum we need.
And then from a cost perspective, your presentation says it's basically 30 basis points ongoing, which could be higher because you can build in fees for distributors and commissions and trailers and things like that. And
Broski, let me connect to your internet, inshallah, man. Let's hit this phone. Those guys, though, she's from the tickets.
The ETNs that have been launched by managers all seem to be priced at 50 bits, pretty much.
Okay.
And plus or minus. The difference between the two is revenue for you to keep.
Okay.
Oh, sorry, upfront cost. So I think roughly 50 basis points plus, no, minus. It just depends on what target AUM we pick. The cost of the notes is 25,000 per note, but they usually come in bundles of 4: accumulation, income, rebate, no rebate. 4. And you only pay for 3, come in blocks of 4. So that's 75. The full platform is a one-off 25,000. So basically, it's 100,000 for absolutely everything, and you only pay half of that. The other half comes when the vehicles are launched and the first trade is done. So that's the only cost. There's nothing supplemental. And we found this out the hard way, frankly. If you go to third-party ECM providers, the list of additional services and their costs runs into about 20 pages, which is why we built our own. So our commitment is full. It's fully inclusive. So you can use our legal resources. There's no additional cost to the vehicle. There's no surprise cost on separate issuance or audit fees. It's a 100% bundled service.
Okay, and that issuance cost, is that built into the vehicle or that is paid by the manager?
It's paid by the manager,
okay,
but you can build it into the vehicle because there's an excess of potentially an excess. You can use the excess to it's a revenue, right? So you can amortize the cost of the vehicles. A lot of people do that actually.
And then for distribution purposes, a commission or rebate that can be custom.
Only by note. So so that kind of typical 4-note structure. Actually, Garrington has 6, which Sol will be familiar with. But the typical 4-note structure is the rebate free. And then the rebate share class has an additional 85 basis points, and we handle all of the distribution to the wealth managers, that rebate payment. They all get their own dashboards and reporting, and it's all there. Sometimes people launch what in funds world you'd call N series or N classes in LATAM, which are basically super juicy rebate paying share classes. It's like Europe and the US 20 years ago. Everything is possible. The only thing we all have to be mindful of course, is you don't want to overload these things. But I think the maximum rebate that we've seen, which is important for brokerage in places like Insignio, is 125. I think is the maximum I've seen on a rebate basis. And you see, the thing is that they get that from certain UCITS funds. So to be competitive in what is largely a UCITS market, actually, the offering these variants is important.
That makes sense. Well, that's all I had. What else should we know or be asking, or anyone else on the call have any questions?
I've talked everybody silent. Sorry about that. I think look, there's plenty of resources that we can provide. You're very welcome to have follow-up calls with other dedicated areas of the business if you really want to drill into structures or capabilities. I think I'm happy to say that with 120 wealth managers and a number of products in market now, we've done that 3 years of building and testing, and so it's